If you have an interest in the stock market, then this video is for you. You see, the stock market is much like your local grocery store. You're always trying to find the best quality good for the best price possible. So let me explain to you how you can better identify those stocks to get a nice return. Grab a beverage and let's talk equity pricing. Hi, I'm Linda and welcome to Life of the Big Four, where we give career, life, and study tips for a successful and prosperous business career. Now before I get started, let's be clear that those prices listed on the large exchanges like the New York Stock Exchange or the Nasdaq are just quoted prices from the most recent transaction. So it's entirely up to you to figure out which ones are under or overvalued. I also want to point out that there are many ways to value a given stock. But today I will be showing you one of the more popular ways to place an intrinsic value on a given stock through assumptions made from investor due diligence and thorough research. With that said, let's talk about the dividend discount model. The formula we will be using here today is price equals dividend paid out per share times 1 plus constant growth rate divided by cost of equity minus constant growth rate. Alright, now let's go over a quick example. Say you're looking at company X that's valued at $38 per share. And through due diligence and research, this is what I find. This past year, the company paid out dividends of $2 a share. And through analysis of return on equity times retention rate, I find that their constant growth rate is 3%. This means that over this coming year, the company will pay out $2.06 per share in dividends. Then through running the CAPM, I find that the cost of equity is approximately 8%. Now let's plug it into our model. 2.06 divided by 0.08 minus 0.03 gives us $41.20. Now recall that this company is trading at $38. I would likely buy a share of this because I think it's currently undervalued and economically worth $41.20 a share. You see, this is a nice way for you to quantify what you think a company's stock would be worth based on assumptions you've made about the company and analysis that you've done.